All right, welcome back to The Explainer. Today, our goal is to unpack a massive piece of financial data, Cavco Industries' fiscal 2026 year-end earnings report, which just dropped on May 21st, 2026. Now, if you've been following the housing market at all, you know it's a pretty volatile space right now. But Cavco's numbers, they tell this totally fascinating story of growth, strategic acquisitions, and really scaling up operations. We're going to break down exactly how they achieve these results, using the data straight from their own report. Okay, let's dive into this. Here is how we're going to break it all down into 5 parts. First, a record-breaking fiscal year. Second, inside the housing segment. Third, the incredible growth in financial services. Fourth, addressing costs and challenges. And finally, building the future. So, part 1, a record-breaking fiscal year. Let's look at the highlights. Here is the bottom line right up front. $2.24 billion. I mean, wow. That is Cavco's net revenue for the entire 2026 fiscal year. In an economic environment that management itself described as uncertain, achieving a top-line success of this massive scale is truly phenomenal. To really put that number into perspective, when we compare fiscal 25 to fiscal 26, we are looking at an 11.4% growth rate. That represents a $230 million leap in just one single year. They didn't just inch past their previous goals, they completely shattered them. You might be wondering, how exactly did they do it? Well, the core engine of their success was moving physical product. They sold a record 20,842 factory-built homes in fiscal 26. That is a 5.5% jump from the prior year. When you're moving actual houses, a jump of over 1,000 units year over year is just massive. Moving on to part 2, inside the housing segment, the core engine. So, how did they actually manage to sell more homes and make more money in a stagnant macroeconomy? Before we get too deep into those heavy metrics, let's quickly ground ourselves. When we talk about Cavco's housing segment, we mean factory-built housing. These are homes that are constructed either entirely or partially inside a controlled factory environment before they're transported to the actual site. It's an efficiency play through and through, and it's the beating heart of their business model. Now, a huge driver for pulling in that $2.157 billion in segment revenue was simply price. The net revenue per home sold actually increased by 5.8%. So the average selling price for one of these homes is now sitting at $103,510. They aren't just selling more homes, they're selling them at a higher average price point. So if we summarize what actually fueled this massive housing revenue, it really comes down to 3 main pillars. First, like we just saw, those higher average selling prices. Second, the sheer increased volume of homes sold. And third, this is a really crucial piece of the puzzle, their acquisition of American Homestar. Fiscal 26 included 6 full months of operations from this new addition, and that just completely supercharged their overall numbers. All right, let's hit part 3, financial services. And guys, the growth here is incredible. Now, what's really interesting about this next bit is that while housing is their core, it was actually a totally different division that became the unexpected booster rocket for the year. Prepare yourselves for this one. Back in fiscal 25, operating income for their financial services segment was $1.5 million. Fast forward to fiscal 26, it's skyrocketed to over $23.3 million. That is a staggering 48.5% year-over-year leap. You almost never see explosive, triple-digit growth like that in established corporate earnings. So how on earth do they manage this triple-digit growth? Well, on the insurance side of the house, they locked in higher premiums while simultaneously dealing with lower claims losses. And why were claims lower? Mainly 2 reasons. First, improved policy underwriting on their end. And second, honestly, they caught a lucky break. There were simply fewer severe weather events compared to the previous year, which obviously meant fewer payouts. But it wasn't just the insurance side doing the heavy lifting. Their lending operations saw a massive Q4 strategic win. They secured a long-term agreement to sell loans to a third-party investor. That specific move cranked up their loan sales in the 4th quarter and directly drove up net revenue. Which brings us to part 4, addressing costs and challenges. We always want to keep a balanced view here. Because, we always try to be completely objective on the explainer. We have to look at the unavoidable headwinds Cavco ran into as well. First up, let's talk about backlogs. A backlog is basically the value of wholesale orders they've received but haven't actually built or recognized as revenue yet. Why does this matter? Well, those backlogs took a slight dip. In March 2025, they were sitting at $197 million. By March 2026, they had dropped to $195 million. It's a tiny drop, sure, but it does show that while they are selling super efficiently right now, the pipeline of guaranteed future work did cool off just a little bit over the year. Then, of course, you have the everyday reality of operational costs. Higher input costs for materials, plus paying out more incentive compensation because of all those extra sales, that's going to take a bite out of your margins. In fact, the factory-built housing segment's gross profit margin actually squeezed down a bit, dropping from 22.9% last year to 22.1% this year. It's just a classic reminder that scaling up your volume usually means it costs a bit more to execute. And when you look at the SG&A, the selling, general, and administrative expenses, the year-over-year comparison is honestly a little tricky. See, fiscal 25 included this non-recurring $10 million non-cash charge tied to some legacy brand intangibles. So if you actually pull that one-time charge out of last year's numbers, Cavco's core expenses definitely went up this year. But that was mostly driven by the cost of integrating that American Homestar acquisition we talked about earlier. All right, let's wrap this up with part 5, building the future. Let's look at the outlook and shareholder value. So we've dissected the past financials, but let's shift gears and see how this builds into their future physical expansion. Check out this quote directly from President and CEO Bill Bohr. He stated, "In Q4, we broke ground on a new state-of-the-art production facility in El Mirage, Arizona. I love this because it really humanizes all those spreadsheets and data points we've been staring at. It provides tangible proof that Cavco isn't just hoarding cash. They are literally laying down bricks and actively investing in long-term physical capacity." But physical expansion aside, the absolutely crucial point here is how they are rewarding their investors right now, $150 million. That's the amount the board of directors approved for an additional stock repurchase program in May 2026. And remember, that stacks right on top of the $160 million in stock they already bought back throughout fiscal 26. So yeah, they are aggressively utilizing their capital to drive immediate shareholder value. We're going to leave you with this pretty provocative question today. Can factory-built homes actually solve the U.S. housing crisis? CEO Bill Bohr explicitly stated that their physical expansion reflects a long-term need for factory-built solutions to the worsening housing crisis in America. Cavco clearly sees themselves as not just building homes, but building a macro-level solution to a huge problem. Whether they can actually scale fast enough to make a real dent in that crisis, well, that's something we are definitely going to be watching closely. Thanks so much for hanging out with us on this explainer, and keep learning.